Everyone talks about a recession, but almost no one shows you the data that points to when it might hit. But when you line up all the forecasts, the models, and the macro signals from every direction, 2026 becomes the first year in over a decade where every major indicator is pointing the same way. This isn't a doom and gloom video. This is data that I've pulled from the IMF, OECD, the Federal Reserve, and the Wall Street analysts that have already been quietly preparing for what I'm about to share today. I'm going to show you the receipts and not the opinions. You're about to see the exact recession probabilities calculated by the New York Fed using the yield curve. You'll also see the IMF, the OECD, and the Fed all forecasting what 2026 is going to look like and why the slow growth outlook is much more dangerous than it sounds. You'll see Wall Street economists putting recession odds as high as 48%. You'll know how rate hikes from years ago collide with tariffs, inflation, and political risk, all converging in 2026. And by the end of this video, you'll understand exactly why 2026 is shaping up to be the most fragile year of the decade. I want to talk about the official forecasts. And when I say that, I'm talking about the biggest institutions in the world, all shifted from saying they are not predicting a boom. They're predicting the weakest multi-year growth since the 2008 crisis. This right here is the growth forecast. On screen, what you're seeing is 2025 to 2026 side by side. The IMF line is showing global growth stuck at around 3%. The OECD and the Fed bars for the US are barely above 1.5%. That is completely stalling, not expansion. The IMF projects global growth at 3% in 2025 and 3.1% in 2026. The OECD, by the way, side note, if you don't know what that is, it is the Organization for Economic Cooperation and Development. It's a group of 38 member countries, primarily democracies with market economies that work together to promote policies in economic growth, prosperity, and sustainable development. It acts as a form of governments to share experiences, seek solutions to common problems, and develop standards for public policies, covering areas like economics, education, and international taxation. Well, they just slashed the US growth from 1.6 in 2025 to 1.5% in 2026, specifically because of the tariffs and the economic uncertainty at the moment. Federal Reserve expects that the GDP will crawl down to 1.6 to 1.8%, with unemployment drifting to the mid 4% range. And the CBO, which is the Congressional Budget Office, shows the same: soft growth, elevated unemployment, and rising fiscal pressure. When institutions predict slow growth, they're not predicting stability. They're telling you the economy has almost no cushion left. At 1.5% growth, even a small shock can turn into a full-blown recession. Here I want to talk about the market models, primarily the bond market, and what it's showing us. The bond market is the one place where money does not lie, and the bond market is still warning you about 2026. Look at this chart. This is the New York Fed recession probability sitting at 29%. And while that 29% doesn't sound crazy, anything above the mid-20s historically meant serious troubles for our economy. The New York Fed's recession probability model is based on a 10-year minus the 3-month yield curve for bonds. And it's giving us the 29% chance of a recession by August of 2026. To be clear, once again, anything above 25% in this model is elevated. Put it this way, every recession in the US for the last 60 years preceded by an inversion of this spread. And we just went through one of the longest and deepest yield curve inversions. Historically, the economy has never avoided a recession after the inversion, especially this severe, without false signals or major policy reversals. The bond market is not predicting a collapse. It's predicting a fragile environment. Being fragile is exactly how recessions begin. Wall Street economists are quietly pricing in a downturn. If you listen to the headlines, everything looks fine. But if you listen to the people allocating billions of dollars, you hear a very different story. Goldman Sachs put the recession probability at 30%. JP Morgan warns of stagflationary slowdown and assigns roughly a 40% odds of a recession in late 2025. And rolling into 2026, Mark Zandi at Moody's Analytics puts the recession odds at 48%. That's the highest this model has ever reached without an official downturn. If you never heard of Moody, by the way, it's a global company that provides credit ratings, research, and data through its two main divisions. The first one is Moody's Rating, and the second one is Moody's Analytics. It's known for rating the creditworthiness of companies and governments, and for providing risk analysis, software, and other financial data to help investors and businesses make informed decisions. Well, again, the surveys of strategists across the marketplace are screaming for recessions of odds between 40 and 80% over the next 12 to 18 months. These aren't internet doomsday people, they are analysts who get fired if they're wrong. They are not hedging for a booming 2026, they're hedging for turbulence. This is the part of the story that ties everything together, because recessions don't happen because of one factor. They happen when several slow-moving forces hit the economy at the exact same time. And the three forces converging are perfectly aligning in 2026, unfortunately. If we look at this chart on the screen, you'll see these three lines. One is showing the lagged impact of rate hikes rising into 2026. One shows the tariffs and deglobalization drag ramping up. And the thick line is the combined fragility peaking right in 2026. Now let's talk about the first force, which is the lag damage from the rate hikes. Because rate hikes don't hurt immediately. They hit the economy with an 18 to 24 month delay, which means the aggressive rate hikes from 2023 and in 2024 are fully landing in 2026, which we're already seeing the signs. Unemployment drifting higher, job openings falling, and several states showing recession-like conditions. This is how every tightening cycle works. The pain shows up long after the hikes have stopped. Now onto force 2. This is the tariffs and deglobalization becoming a full drag in 2026. Tariffs don't break the economy overnight. They erode it over time. The OECD said the US growth is being cut almost in half because of the tariff intensity and geopolitical uncertainty. Mark Zandi estimates the deglobalization will subtract 1.19% from US GDP in 2026, while AI only adds about 0.6%. Larry Summers warns tariffs could eliminate 2 million jobs and cost families more than $5,000 per year. By 2026, the cumulative drag on tariffs can hit in full force. And that drag lands exactly when the economy is already running at only 1.5% growth, which we spoke on earlier. Now let's move on to force 3, which is fiscal and political fragility that peak at the same time. The US entered late 2025 with a 43-day government shutdown, raising debt costs and declining foreign demand for our treasuries. Political volatility, tariff shifts, and economic uncertainty all peak during the election to administration transition window, with growth barely above stall speed. Even a small disruption becomes a recession trigger. This isn't about one big thing that triggers it all. This is about a multiple slow-burning fuse that reaches all explosive points in 2026. So let's go to the most important part. What are the numbers showing us? Well, when you combined everything together, the institutional forecasts, the bond market signals, and Wall Street probability models, there's one clear conclusion that appears, and that is that a recession in 2026 is not guaranteed, but it's way more likely than a normal year. Now, I'm going to share with you some very important information to give you context on this probability number. A defensible, evidence-based range is 30% to 50% probability of a recession in 2026. The base case sits at around 35 to 40%. Now here's where it gets interesting. For context, the historical average recession probability during a healthy expansion is around 15%. That means recession risk in 2026 is 2 to 3 times higher than normal. Not inevitable, but too large to ignore. Now, with that being said, what does a 2026 recession look like? Is this going to be the likes of an 08 collapse scenario? This is a shallow to medium recession, but still enough to reshape how wealth looks today. So how do you use this information? Clearly, this video isn't about panic. It's about positioning. It's not the end of the world, but it's the kind of recession that creates winners and losers very fast. So how do we use this information? What needs to happen is reduce fragility, avoid floating interest rates, increase your liquidity, and keep optionality. Favor companies or assets with strong cash flow, low debt, and pricing power. A recession is risky if you're unprepared. A recession is opportunity if you're positioned correctly. Something I've added inside of my very own portfolio is a trading algorithm that uses machine learning to take thousands of trades annually. And it does this whether I am on the computer or not. The reason I bring it up is because it's not holding positions in hopes that a position or a stock will increase in valuation. It's finding micro opportunities in and out of the market, which allows me to be kind of in a market neutral situation to where if the S&P rolls over or anything looks crazy in the NASDAQ, my portfolio is not affected essentially from that because the algorithm is finding micro opportunities inside of currencies and different commodities. If that sounds interesting, on this channel, I documented $100,000 inside of a trading algorithm in which I just completed a 365-day journey on. Instruments like that will allow you to find the edge that the average person doesn't have, which could potentially turn you from loser to winner very fast or keep you in a safe position. I think in the future, small slivers of portfolios will be allocated to things of that sort because you need to find how you can get an edge instead of just holding and hoping, because that does not work if you're trying to be behind the wheel of your portfolio, because unfortunately your emotions will always get involved. So look, the data doesn't guarantee a recession in 2026. It just shows that 2026 is the most fragile, most vulnerable, and most mathematically exposed year we've ever seen to a recession since 2008. And ignoring that isn't optimism, it's negligence. If you found value from this video and you want to be a savvy investor so you can stay up to date with the times, hit the subscribe button, and like always, thank you for watching.